Top 5 ways to hedge against inflation. Guys, inflation in post-corona had just struck 7.9%, and the prices of literally everything across the board just keep rising every now and then. Listen, I understand you, and this video is for you, so watch till the end. In this video, I will answer questions like what is inflation and how does it affect investors. Inflation is a rate at which the value of a currency is declining consequently, and the general level of prices for selling and service sectors kept on rising. It is a natural occurrence in an economy, but inflation hedging can be used to offset the anticipated drop in a currency's price and can also help protect the value of an investment. Hey, welcome back. It's from we empower you to groom yourself with stable mindset and financial skills that you need to prosper in your life. Being professionally sound in finance as an investor over 15 years, the content I am providing here is educational information and should not be taken as financial advice, so always consult your investment advisor. So, if you're new here, make sure you click that subscribe button below and like and share this video. Here are the top 5 asset classes to consider when seeking protection from inflation. 1. Reallocate money into stocks. If inflation returns, it's generally a punch in the jaw for the bond market, but it could be a shot in the arm for the stock market. Consider reallocating 10% of your portfolio from bonds to equities in order to take advantage of this possible trend. A 60 by 40 stock bond portfolio is an easy investment strategy and will help you hedge against inflation, but keep in mind it will underperform over the long term compared to an all-equity portfolio because of the effects of compounding interest. You may find yourself missing out on returns compared to a portfolio with a higher percentage of stocks. 2. Diversify internationally. There are several major economies in the world that do not rise and fall in tandem with the US. Market indices, such as Italy, Australia, and South Korea. Adding stocks from these or other similar countries can help to hedge your portfolio against domestic economic cycles. Bonds from foreign issuers can provide investors with exposure to fixed income that may not drop in price if inflation appears on the home front. Exchange-traded funds, ETFs, and mutual funds are two of the easiest options to diversify investments into international markets. These types of funds are a low-cost way to invest, compared to purchasing a portfolio of American depository receipts, ADRs, or foreign stocks. If you hold S&P 500 index funds, you may want to consider adding an international index fund to your portfolio. 3. Consider real estate. There are many advantages to investing in real estate. This asset class has intrinsic value and provides consistent income through dividends. It often acts as a good inflation hedge since there will always be a demand for homes. Regardless of the economic climate, and because as inflation rises, so do property values, and therefore the amount a landlord can charge for rent. Because real estate is a tangible asset, however, it's illiquid. An alternative to consider is real estate investment trusts, REITs, which are more liquid investments and can be bought and sold easily in the markets. REITs are companies that own and operate portfolios of commercial, residential, and industrial properties. Providing income through rents and leases, they often pay higher yields than bonds. Another key advantage is that their prices probably won't be as affected when rates start to rise, because their operating costs are going to remain largely unchanged. An example of a REIT with broad exposure to real estate and a low expense ratio is the Vanguard Real Estate ETF, VNQ. 4. Look to TIPS. Treasury inflation-protected securities, TIPS, are a type of U.S. Treasury bond designed to increase in value in order to keep pace with inflation. Because they're backed by the U.S. federal government, they're considered among the safest investments in the world. The bonds are linked to the Consumer Price Index, and their principal amount is reset according to changes in this index. TIPS pay interest twice a year at a fixed rate, which is applied to the adjusted principal. The principal rises when there is inflation and falls when there is deflation. TIPS come in 3 maturities: 5-year, 10-year, and 30-year. There are, however, a few risks that come with TIPS. 5. Buy bank loans. Some businesses can thrive during inflation when prices are rising. Banks, for example, earn more money as interest rates rise and profit off the increased price of loans. Buying senior secured bank loans is a good way to earn higher yields while protecting yourself from a price drop if rates start to rise. Keep in mind, though, that there may be a substantial time lag until the value of loans increases as the rates rise. An example fund of this type is the Lord Abet Floating Rate Fund, LFRAX. It's a high time to start investing your money or other asset to build a secure future, as according to many economists coming 5 years could be really terrible if not planned in the right way. Do the risk management, connect your investment to your financial plan with the help of financial advisor in order to play safe. Goodbye.